Discoms, Gencos, entrepreneurs have to decide on the contractual arrangements they are going to make to supply electricity into the market. And we want to explore a number of different vehicles for accomplishing this. In the end, we're going to conclude that a mix of different kinds of contractual arrangements is both a natural and efficient way of organizing electricity markets, and we'll explore the different characteristics of long-term contracts, shorter-term arrangements for allocating resources, and then exchange-traded electricity. We'll start with long-term contracts. Any large, long-lived capital investment is going to involve a long-term financing contract, because an entrepreneur is allocating assets that will only be paid back over a long period of time. In our examples, we're using 30 years. So there's going to be a contract for payments over 30 years. Whatever else the terms of the contract includes, there will be a contract for a fixed set of payments. So any long-term capital investment is going to involve some contract that extends for a number of years, and even the useful life of the asset. We're going to focus on contracts between the generator and the potential buyer of the generator's output, usually the DISCOM. The DISCOM is going to be the buyer of the output. The generator is going to be involved in the financial contract for the building of the capacity. Possibly the generator is the builder of the capacity and will be borrowing money in order to build the capacity and supply the electricity. And so the generator is going to will often enter into a contract with the buyer of the electricity to smooth out the payments for the capital asset that's being built. Long-term contracts between generators and distributors of electricity are a feature of electricity markets everywhere. And in fact, there's reason to believe that long-term contracts are an important feature of electricity markets. That is not to say that they are the only way electricity should be traded. In fact, what I'm going to conclude at the end of today's unit is that an efficient system of providing electricity to customers will involve both long-term contracts and short-term buying and selling of electricity. What are some of the important general characteristics of long-term power contracts? Well, they tend to be large, relatively infrequent transactions between buyers and generators. Large sums are involved, long-term commitments are involved, and so there's considerable risk that what we expect to occur over the course of this long-term contract will not actually happen. That demand will be higher or lower than we anticipate. That fuel costs will be higher or lower than we anticipate. So there's lots of risk over prices of both inputs and outputs. With a limited number of potential traders and low liquidity in the market may not even be competitive. So there's a risk to the parties that there will be market power on one side or the other of a contract. Power purchase agreements are not suited to rapidly responding new information about costs, demand, prices, technology, and other things. But they do provide some certainty to investors, and certainty to investors is going to be an important characteristic in arranging financing for long-term assets like generating assets, base load power plants that are expected to last for 30 or 40 years. Getting financing will be greatly facilitated by having long-term power purchase agreements for some of these assets. Power purchase agreements are cumbersome. They're long-term, they're large contractual arrangements that are negotiated between buyers and sellers and can be quite cumbersome. So the question is, why would they be used? Well, they're used a lot because they're an important adjunct to generator financing, as I've already mentioned. It may be very costly for an entrepreneur to get financing without a PPA in place. This is not always true, and some parties are going to have the wherewithal to absorb the financial risk. On the other hand, other potential generators are going to find it necessary to have some sort of contract in place before they can obtain reasonably priced financing for especially large generation projects. PPAs reallocate risk between the generator and the buyer. For example, a generator and a DISCOM will enter into a power purchase agreement in which the DISCOM will agree to absorb much of the risk of future changes in the price of electricity, future changes in the price of fuel. In return, the builder of the generator will have lower risk and will have lower costs of financing. So PPAs facilitate long-range capacity planning in the presence of uncertainty over future outcomes. And in fact, it's been the experience in other electricity markets that having a share of generation under long-term power purchase agreements can reduce incentives for short-term market manipulation. If the electricity from a given generator is under a long-term power purchase agreement, then the generator is not in a position to take advantage of transmission constraints and other transient opportunities for expressing market power, because the prices at which they can sell electricity are fixed under the contract. So there are reasons to think that long-term purchase power agreements are beneficial as a part of a mix of arrangements for providing power to the grid. Because for the share of the electricity generated that is under power purchase agreements, the ability to take advantage of market power is limited.